How's everybody doing today? This is Bob Iacchino from Path Trading Partners. Mike Arnold is also here. I want to start out by thanking Nadex and Jamie for allowing us to present here. We are Path Trading Partners, and this is Trading in the Money Nadex Binaries. It's a series of webinars we different times and situations where you want to put on certain types of binaries. A lot of traders don't necessarily separate the types of binaries, but there are types, and we'll go into that, and we'll get started, as we always do, with a quick risk statement. Now, you have to take this seriously. We don't just read this to cover our butts. This is serious stuff. People think that trading is such a simple and easy thing to get involved with, but it's not. It's an extremely serious thing. It is a trade, it is a craft, and you start out with the information that's in these risk statements. So I'm going to read this. Bear with me while I do. This presentation is for information purposes only and does not constitute investment advice, nor an offer, solicitation, or recommendation to acquire or dispose of any investment or to engage in any other transaction. This presentation is not intended for solicitation purposes, but only for use as general information. All descriptions, examples, and calculations contained in this publication are for illustrative purposes only. The risk of loss in trading can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition. Past performance is not indicative of future results. You know, we take that very seriously because, again, we can show you guys the best time to put trades on. We can teach you guys strategies, but we cannot evaluate each individual's personal financial condition. So that's up to you to do. Trading ends up being about personal responsibility and nothing else. At the end of the day, you can learn whatever you learn, but if you're irresponsible with your own situation, you have to look in the mirror for that. So that's why we read this risk statement. That's why we take it very, very seriously, and that's why Nadex takes it very seriously, and they would make us read this even if we didn't do it on our own. So take it seriously. Make sure you trade from a risk perspective first. So who is Path Trading Partners? Path Trading Partners is a trading and education firm. PTP's mission was to form a trading firm that educates, supports, and backs traders who are committed to probabilities, discipline, and long-term trading success. This is achieved by following the correct path. We are not high-frequency traders, and we are not day traders. Those are labels we don't place on ourselves. What we are is a firm that believes in a long-term success in trading covering time frames dictated to us by products, markets, and price action. Notice that dictated to us is highlighted because we don't walk into a trading day and say, I want to do X, Y, and Z. We walk into a trading day with a method or a process of analysis, and we take what the market gives us. The market dictates to us what we're going to trade. We don't try to dictate to it. Extremely important that you guys realize that you have to take what the market gives you and not walk in with some sort of idea that I'm going to impose my will upon the market. The market is never wrong. So who is Mike Arnold? Well, Mike's a 24-plus year market veteran, and he's been teaching traders online and in person for 10-plus years. He was and continues to be a strategy and development consultant to multiple outside hedge funds. He's a former options market maker on multiple exchanges, including Chicago, New York, Switzerland, and Canada. And he is the current head of technology and trading system development for Path Trading Partners. I really don't like to read my own bio. You guys have heard me go over it briefly in the past, so I'm just going to put it up here. But the most important part about my bio is that I was a principal, and still am, of a fund of funds, and was a member of the investment committee, which I no longer am. And what we did was we covered early stage managers. What that means is managers with 3 years of track record or less. So my job was to look at the strategy, look at the returns of early stage managers and decide whether they can make money for us over the long term or not. I also appear on CNBC, Bloomberg, CNN, etc. I still do 2 to 3 appearances a week, anywhere from 5 to 10 a month, depending. and I have taught and mentored over 5,000 students. I've been teaching online and live since about 2002. So again, this is on the recording. If you guys want to read this bio, I don't really care to go into it any further. Let's talk about the prior classes because they're important. In prior classes, we cover the concept of moneyness and classifying a Nadex binary option as either out of the money, at the money, or in the money. I mentioned in the beginning of the intro that there are different types of binary options, and those types are decided by where the underlying is trading, not necessarily by the exchange itself. We taught the Greeks what they are, how they apply to Nadex binary options, and how they can help the binary options trader understand the price movement and price changes due to theta and vega. If you need to learn these concepts, which it's our opinion that all of you do need to learn these concepts, watch the recordings of our prior Nadex binary classes after this webinar, and they can be found at nadex.com/trading-academy/webinars. Okay, you just basically go to the Nadex site, look under webinars, look under archives, and you'll find them there. Very important that you guys learn this stuff. This is not, at Path Trading Partners, we teach strategies, but we teach how to apply those strategies to binaries and spreads on these free webinars. After learning the Greeks, most traders wonder how they can effectively translate that knowledge and information into useful and actionable trading information. And that's precisely what we're going to do in this class when we look to trade Nadex binaries that are in the money. First, though, we're going to do a very brief review to ensure that everyone is on the same page. Some of you may be new, some of you may have not watched the older webinars, so let's do a quick review. So binary options are worth either 100 or 0 per contract upon expiration. If the Nadex settlement index is above the strike price of the binary option, then it's worth $100 at expiration. However, if the Nadex settlement index is equal to or below the strike price of the binary option, then it is worth 0 upon expiration. Very important, equal to or below. Okay, not just below. Equal to also makes it worth 0. So now let's take a look at out of the money versus in the money. So we refer to a binary option being out of the money if it's trading below the strike price. We refer to a binary option being in the money if it's trading above its strike price. A binary option is at the money if it's trading right at the strike price. In other words, if you have a binary option, let's say in the US 500, which relates to the E-mini S&P at the CME, and let's say it's a greater than 2010 binary option, if it's trading right at, if the underlying is trading right at 2010, then it's at the money. But for the purposes of this course, we consider at the money binary options to be out of the money, since they are worth 0 if the Nadex settlement index settles right at the strike price, which again is at the money. So think about it this way. Think about in the money being if it's settled here, you would make money. And think about out of the money being if it's settled here, you would not make money. And at the money fits that not making money scenario that I just described. So essentially at the money for the purposes of this presentation is out of the money. So let's take a look at a brief options graph here. You've got binary price versus the underlying. Again, I just used the example of the 2010 strike binary option in the US 500. So right down the center here, if the underlying is at 2010, that is at the money, which again, for the purposes of this, we consider that out of the money. Anything below it is out of the money, and anything above it is at the money. Notice the curve of the actual option. This particular graph is taken with about 30 minutes until expiration, with about a 20% volatility, just on average. We'll cover some of that as we go forward. This is what the curve would look like. This is what the price change in the binary option would look like. So if the underlying is at 2008 with 30 minutes left, the price of the binary option would be right around 25 or so, close to 30. If you could look at the price on the side here. And again, if it's at about 2014 right here, that's going to be about 85 or so. That's what this curve represents, with about 20% volatility. Let's talk about intrinsic versus extrinsic value. If we examine the intrinsic and extrinsic value of a binary option, intrinsic value is defined as the in-the-money portion of the option value, or the value that the option would be worth at expiration. Extrinsic value is defined as the worth assigned by external factors, such as time and implied volatility. Intrinsic and extrinsic value are very interesting when examining binary options. Unlike traditional options, where the intrinsic value increases in a linear fashion in conjunction with the underlying after it passes the at-the-money strike price, binary options increase in a digital fashion upon crossing the at-the-money strike price boundary. For example, when the price of the underlying passes the Nadex binary option at the money strike price, the intrinsic value goes from 0 to 100 instantly. So because binary options are a yes or no proposition, 0 or 100, the intrinsic part of the option premium goes from 0 to 100 instantly. So use the example of the 2010 US 500 option. The second that the underlying passes 2010, the intrinsic value is 100, because that's the only value it can have upon expiration. It's either going to be 0 or 100, right? So the intrinsic value, again, unlike regular options, moves in a digital fashion. It immediately moves from 0 to 100, which complicates the extrinsic value a little bit. When a Nadex binary option is trading at or below the strike price, meaning at the money or out of the money, then all of the value is extrinsic value. Because again, when it's below, let's use the same example. When it's below 2010, the intrinsic value is 0. At 2010.01, it's 100. So all of the value when it's below the strike price is extrinsic value. When a Nadex binary option is trading in the money, then the value is a combination of extrinsic and intrinsic value. But what's interesting to note is that when the binary option is in the money, the extrinsic value is negative, which is why the trading value is less than 100 before expiration. So if we take a look at what makes up Nadex binary option premium, you have a combination of intrinsic value, which again is the value at expiration, or what would the option be worth if it settled right at this second, right at the second you're looking at, and then extrinsic value, which is time value and implied volatility. That's what makes up extrinsic value. So let's take a quick look at Nadex binary option Greeks. We can apply these Greeks to Nadex binary options, and the definition of each Greek is as follows. Delta is the sensitivity of the binary option price to price changes of the underlying. Gamma is the sensitivity of the delta to the price changes of the underlying. Theta is the sensitivity of the binary option price to the passage of time. Vega is the sensitivity of the binary option price to changes in the implied volatility of the underlying. Notice early in the presentation, we talked about theta and vega, right? And then rho is the sensitivity of the binary option price to the changes in interest rate. We're not going to really worry about rho. So you need to know what it makes up the intrinsic value. It's very simple to understand what the intrinsic value is, right? What's the value at expiration if it were to settle right this second? And in binary options, it's digital. It's either 0 or 100. There's no math to do, right? If it's above the strike price, it's 100. If it's below it, it's 0. So you need to understand extrinsic value to understand trading in the money binaries. So extrinsic is time value, and it's time until the spread expires and the volatility of the underlying. So it's theta and vega. Time to expiration and volatility of the underlying. Now, in a regular option, you would worry about rho. We're not going to worry about rho in binary options because, again, rho is the change in interest rate, and it's going to be extremely rare that the interest rate changes since these are short-dated options. In other words, they expire essentially the same day. So there's not going to be interest rate changes for the most part on that particular day. So those are the components of extrinsic value. I'm going to go ahead and turn it over to Mike now to go over what we're going to talk about in this session.
Okay, great, Bob. Thanks for that wonderful introduction and recap. Everyone can hear me fine. So let's keep elaborating on this information and really get into it in depth. So in this session, we're going to examine in depth how time or theta, volatility, vega, market direction, and momentum affect Nadex binary options when trading them in the money. The session will only focus on trading the Nadex binary options that are in the money. The prior Path Trading Partner session focused on trading them when they're out of the money. So if you missed that session, please review the recording. It's great, and you don't have to do it now. You can go through this one and then review it after, and then you'll be able to put these two together and understand different aspects of no matter where you're trading them, in or out, which strategy you should use. You can even do strategies where you combine trading them in and out. So there's a bunch of stuff you can do once you understand all the different places this can trade. We will also mainly be focused on trading the binary options from the long side when reviewing the Greeks from the point of simplicity. Things when you view them from the short side, your graphs get flipped backwards or upside down depending on how you want it because the time capture is different, et cetera, et cetera. So for the point of simplicity, we're going to be just looking at it from the long side. Many traders overlook trading the binary options when they're in the money, or especially very deep in the money, because they look at the reward to risk and see they potentially are taking on more risk than reward that they can obtain by holding the binary option to expiration. So they're just looking, too many traders are just focused on this reward to risk concept and will only take positions on where, okay, I'm putting on very little, I had a lot of reward for very little risk. And naturally, when you're in the money, it's going to be skewed the other way. You're taking on more risk than reward, especially as you go deeper and deeper in the money. But there are conditions, market conditions, when you'd want to be doing that. And so this is especially true for binary options that are significantly in the money. In order to have a chance of trading binary options successfully, the trader needs to understand the market conditions that are best suited to initiate these kinds of trades. There's all sorts of market conditions, okay? There's high momentum conditions, there's stagnant conditions, there's trading range conditions, there's really trending conditions. There's different time of day conditions. It might be very busy after the open, or it might go quiet waiting for the Fed to speak. The Fed was speaking today, Yellen was speaking today. So there's different kind of conditions, and knowing what conditions are best suited to put different positions on, or even combining positions, will make you a well-rounded trader. And then it's like having a toolbox, and the toolbox is filled with different tools because you understand the different conditions. If you just open the toolbox and you only had a hammer in it, then everything's gotta look like a nail because that's your only use for the hammer. We want you to have the hammer in there, the screwdriver, and the pliers and everything else, so you can then do whatever job you need to do depending on market conditions, and apply what strategies you may know and what we're teaching you now, and say, I might want to consider this kind of position that does a theta capture for the market conditions that I'm now experiencing. A well-rounded trader should consider all the market conditions, the required stop, and the projected target to determine the best binary option for each trade, not just looking at your final possible reward to risk. Remember, a lot of times you'll be looking at the window trading Nadex things, and that's your final reward to risk, like if you hold it to expiration. And there might be times where you're not going to hold these to expiration. There might be times when you are going to hold these to expiration. There might be times when market conditions change that dictate, hey, I want to get out of the position. Once you really understand how the Greeks work together with the binary options, you can say, all right, the reason I entered this trade was maybe to do theta capture. The market conditions are changing, and they do not warrant me staying in a trade where I am doing a theta capture strategy for a variety of reasons. It could be implied volatility is changing in a way that could be hurting your position without the underlying moving. And we're going to go through those in the following slides. So once you understand the market conditions that are beneficial to putting on an in-the-money binary option when it is trading, you'll be one step closer to becoming a complete binary option trader. So again, we're looking at this week, we're looking in this area. This is a 2010 strike price binary option. This is the different prices the underlying could be trading. So we're looking, if it's a 2010 strike price binary option, you know, we're trading above 2010. That makes it in the money. And this is a specific curve to this curve. And if you've seen what we've done before, these curves change over time because time's always changing. And these option models, time's one of the inputs, they also are dependent on a specific volatility. And implied volatility can also be changing over time. So this would be a snapshot in at 15 minutes ago with a specific implied volatility. This is how a price for a binary option that you're long would appear. So if the underlying was trading down here around 2008, that option with 15 minutes ago could be priced around 20. It gets up in the money, let's say at around 2011. You know, it might be trading now at 57. Underlying goes up all the way, and this is with 15 minutes to go, maybe around 2015, it's trading, you know, upwards of $90. So you can follow along with this curve. We're going to be focused on the box that's in the money for this webinar. Now, Bob already went over some extrinsic and intrinsic value, so let's get into it a little more in depth. When trading these Nadex binary options that are in the money, there is both intrinsic and extrinsic value present. Bob went over that with how it changes in a digital fashion. It goes intrinsically from 0 when it's out of the money or at the money to 100 when it's at the in the money. And you're going to see why it has to go that way intrinsically, and then how the extrinsic value is actually negative and you begin to capture it back. So intrinsically it's worth that $100 when it's in the money. The moment it passes the in the money, intrinsic goes from 0 to 100. The reason this is a prior value to expiration is less than 100 is due to the extrinsic value, which is negative. Negative extrinsic value subtracts from the intrinsic value. That's why prior to expiration, it's trading less than $100, unless it's very, very deep in the money when it could be trading almost near that $100 because there's very little extrinsic value left. So in a trader's long and in the money binary option, every moment that passes helps the trader since the passing time actually lowers the extrinsic value. Your extrinsic value gets closer and closer to 0. So it gets, you know, you're adding to it because you're adding to a negative. So it actually decreases that negative and brings it closer to 0. That's how the time passing increases the value of the option. It'll be easier to see graphically. So if price action is either slowly trending further in the money or stagnant and not moving further in the money, then every minute that passes helps the in the money binary trader. It's easy when you think about it. Hey, if I'm long this binary option and it remains in the money until expiration, if it stays above that strike price, I'm going to make that whole $100. All right, that's the payout. Now you're going to make that $100 minus what you paid for it, of course. So you're going to make that difference, but you're really focused on, hey, if it stays above this level, that it's going to pay out at that $100. Well, the underlying does not have to be moving further in the money for that to happen. It just has to stay above that barrier. It has to stay above that level. Opposed to trading out of the money, it's got to be moving. So you don't really care necessarily if the underlying is not moving if you're long higher. It just can't move lower to pass and go from in the money back to out of the money, because that will cause you an issue if you then hold it to expiration. So as the binary option gets closer and closer to expiration and it remains in the money, okay, that time decay actually accelerates and it helps you more and more. It's also especially true as it gets further in the money. So let's take a closer look at how time affects an in the money binary option. Remember, theta is the time decay of the binary option. Theta can help or hurt the binary option trader depending on if the binary is in the money or out of the money. If the underlying price remains out of the money, then time is working against the trader. We went over that repeatedly last week. Time's always working against you when it's out of the money. Once it's in the money, even by 1 cent, let's say, it's time's working for you. If the underlying price remains in the money, then time's working for the trader. So when a trader is long a binary option, and this is, we're looking at this from the long side, and it's in the money, theta is positive, which causes the extrinsic value to approach zero as each minute passes. Why? Because you're adding a positive value to the negative extrinsic value, which makes it less and less negative. As the binary option approaches expiration time, the time decay increases rapidly. This is now a graph comparing the different times and how it affects the in-the-money price of the binary option. Again, we're looking in this shaded box. So if we were, let's say we were at 2012, the underlying is trading at 2012, and this is a 2010 strike binary option. 60 minutes to go, this option might be worth, let's just slightly above 60, let's call it 62. If the underlying does not move and stays at this 2012, or it might trade up and down, but let's say we look at it 30 minutes later and it's back to trading at 2012. That option, even though the underlying is still in the same place, 30 minutes has passed, that option is now worth, we'll call it closer to maybe 68, close to $70. We go away for 15 more minutes. We come back. Hey, the underlying is still trading at 2012. What's my option worth? All right. It would be worth now, it's over, maybe it's at $75. We see we're at this gray curve, we go over. It's closer to that 80. Nothing else changed besides time. And implied volatility with this is always constant. Let me just put that out there. So we're assuming implied volatility did not change. We go back for 10 minutes later, we come back, hey, underlying is still 2012. Look at that, 5 minutes to go. My option's now worth 90. And with 1 minute to go, it's almost worth that full $100 at a certain strike price. So you can see how just the passage of time changes the extrinsic value, and the extrinsic value goes less and less negative. Remember, this was always worth 100 anywhere in this box. Yet the reason it changes is because that extrinsic value, which was taking away from that $100, is decreasing as time gets closer and closer to zero. Here's now how the theta looks for in the money. You can see it is positive. Last week we went over when it was out of the money. Down here it was negative. That's why every minute that hurts, every minute that passes and you're out of the money actually decreases the value of the option when you're out of the money, or even at the money it's zero. But when you're in the money, it's positive. So it's decreasing the extrinsic value. It's making it get closer and closer to that $100 value. That's what the curve looks like with 15 minutes to go and a specific implied volatility. And you can see that as you get further and further in the money, the theta rises. So the time decay has a more beneficial effect until you pass a certain level, and then it starts dropping off again. But you can see, like 2011, if the underlying is trading at 2011, the time, every minute that passes adds, this would be adding a certain amount. We'll just call it slightly above the $5. When you're at 213, it adds more and more, okay? So that's what we're showing you here. Theta versus time. Now this is keeping implied volatility the same and just showing how theta shifts as the time gets closer to expiration. So 60 minutes to go, you can see it's positive, but it's not really positive. As we get closer and closer to that expiration time, theta gets more and more positive, which means that every minute that passes helps your position more and more. It actually subtracts more from that negative extrinsic value, or it adds from a positive sense more to that extrinsic value and reduces it, so that gets closer and closer to $100, and it accelerates. All right? You can really see with 5 minutes to go, it starts getting more and more value. With 1 minute to go, it really kicks in. So that's when you see these binary options, especially that are trading just above the at the money price, you know, because when they're roughly at the money, you know they're trading right around that $50 mark. But if they're staying above that at the money price and you really watch them going into expiration, you can see how those values change rapidly, especially if that underlying is just sitting at just slightly in the money. That time decay really kicks in, that every minute that passes will that option will get closer and closer to that $100 value. And you can also see how the theta gets more and more positive and gets closer to the strike price as the time gets closer to 0. So let's translate this into some market conditions that are suitable for this kind of trading. One of the best times to trade in the money binary options is during quieter and slower trending market conditions. In the money binary options are not advised when the market could be headed into high volatility conditions, especially when the underlying could begin a trend against a binary option position. So you don't want volatility to really be picking up, because it's going to change, and we'll look at Vega and how Vega and increases implied volatility hurts your in the money binary position. So you don't want that. You don't want this to start trending against you. Obvious statement, but you don't want this to go from in the money back to out of the money. So if you're long, you don't want the market to start trending down, especially rapidly. If you know it's substantially in the money and it just starts this slow back and forth, maybe a slow trend down, but a very slow trend, and it's remaining in the money because the market conditions are really stagnant and it's sort of just trending slightly against you, that can still be fine because you're still making the theta. But if volatility and momentum's picking up and this starts trending rapidly against your position, you don't want to be in this, especially as time really approaches 0. Because if it drops out of that in the money where you're capturing the theta, where time's working for you, once it passes that barrier, that at the money barrier, time's now working against you and accelerates into expiration. It's highly recommended that the in the money binary option trader uses a significant support level in the underlying, which is at or slightly above the strike price for a long trade. So if you're in these kind of trades where you're in somewhat stagnant market conditions, you want, and you're long this, you want a really good support level in the underlying that's preferably above the strike price. So if that is tested, you know, if that's likely to hold and it's likely to keep the underlying above that at the money price, so that time decay is really working for you. Conversely, for a short in the money binary option trade, it's recommended that there's a significant point of resistance in the underlying at or slightly below the strike price. So if you're going to flip this around and be trading, you want to, your whole theta flips upside down if you're trading it from the short side, and then you want it to remain where you're still getting the theta capture, so that it's just the opposite of what I said for that long position. These support resistance levels are a good idea because they provide proven areas that the underlying should not trade beyond, thereby keeping the probabilities that the underlying remains trading in the money for the binary option. Okay, you want, the market can go tested, especially during slower conditions, so maybe during lunchtime conditions, or maybe the market's waiting on a news release that's going to come out after this binary is going to expire. So even if it tests somewhere at the money, it's staying above there, so you get that decay working for you, so you're capturing that theta. These levels also provide the trader with a level that, should it be broken by the underlying, signals a trader that they should consider closing out the binary option trade. What's really good, let's say you have this support level, and you know, I don't want the market to get beyond, we were using a 2010 binary example. So maybe we have a key support level at 2011. Well, if that level starts getting broken and violated by the underlying price trading, and we still have time to expiration, that might signal that, hey, that it could get below that 2010 strike price, which would really hurt us. So we want to maybe consider, maybe the reason we got in this trade has changed. that level might not hold. We might want to exit it early and not take the chance of the binary option expiring worthless. And us, especially going if it drops below the at the money price, now we're no longer getting that time decay working for us. It's working against us. That's where, hey, we maybe want to get out of this thing because our trade, the reason we got in it, has now changed. Slowly trending markets or stagnant markets are ideal for pricing in the money trades due to the tendency for implied volatility to remain stable or fall as the in the money binary option approaches expiration. TC, it means theta capture. So if you ever see, if we're doing any webinar and we're talking about TC trades, those are theta capture. That means time is working for us. Every minute that passes, we do not need the market to move farther in the money. We just need time to be passing, and we're going to benefit from that. That's what a TC trade means. Many times these kind of conditions can be found after a period of strongly trending market that has broken a key support resistance level and is consolidating on the other side. So maybe we've had a big run up in the morning, and now we've gone above a key support level in the S&P 500, and we're going into lunchtime conditions. So it might start a nice horizontal channel where price is just moving slightly up, moving slightly back, up and back, but staying above that key support. Great time to consider one of these in the money theta capture binary positions where, hey, I got that key support level to lean against. Every minute that passes during these lunchtime, more stagnant conditions, also when implied volatility could be falling, and we'll get into that. Those are things that will help my position. I have theta working for me, so I might want to consider entering into one of these trades. So these kind of consolidations after strong moves also tend to reduce the spread's implied volatility, which is extremely beneficial to the in the money theta capture trader. Let's get into that implied volatility and how implied volatility affect binary options. Remember, implied volatility is one of the inputs to the binary option pricing model. Implied volatility can change without the actual volatility of the underlying market changing. And the option market makers can increase or decrease the implied volatility based off what they assume the market might do before it actually does it. Okay? That's key. So you could see still stagnant conditions, but if the price of the binary option starts trading in a way you're like, hey, time's passing and underline's not moving, but the spread's changing, or the binary option is changing, the price is changing in such a way that I'm not really understanding. It could be a change in the implied volatility. So what kind of implied volatility do you want? You want steady to decreasing implied volatility. A decreasing implied volatility is the same as time passing and causes a binary option to move closer to its full intrinsic value. If the implied volatility is increasing and the underlying price remains stagnant, then the binary option's price will increase and move farther away from its full intrinsic value. That should say the binary's option extrinsic value will increase in a negative sense. Okay, and I'll show you this graphically. As time approaches expiration, the effect of the implied volatility changes shift closer and closer to the binary option strike price. So here's what Vega does. And this is for a 1% increase in volatility. So this is with a certain timed expiration. We are in the money, and this is a curve of Vega. This is not a curve of the price of the binary option. This is a curve of what volatility changes do. So every time implied volatility were increased 1%, it actually has a negative effect on the price of the option because it makes the extrinsic value more negative, which takes it further away from that $100 value. You can see that easier on this graph. So all that's changing, we're holding time constant. So let's just say this is with 15 minutes to go. The only thing we're changing is the implied volatility, which you can see down here. So if we're trading, let's say at 2012 with 15 minutes to go, and the implied volatility is maybe 10%, the theoretical value of this binary option should be worth about $90. So the extrinsic value is only a -10, the intrinsic's 100, so it's worth 90. If the implied volatility goes from 10 to 20% though, look what happens. And the underline's still at 2012. This option is now only worth 80. Why? The extrinsic value went from -10 to -20. So now it subtracted $20 from that 100. The only thing that changed was the implied volatility. That implied volatility now goes, let's say, to 40. Wow, that option, the underlying did not move. That option is now only worth 65. Well, let's think about this logically. If an option market maker is increasing the implied volatility, they expect more and more volatility to come in the market at some point before that binary option expires. If that volatility actually comes in the market, it means there are more possible outcomes for that to happen. Therefore, it's more likely this thing could also go out of the money. That's why it actually decreases the price. It's sort of like with more time to go to expiration, there are more possible outcomes, right? With 60 minutes to go, there are more possible circumstances that could make an in-the-money option expire out of the money. Therefore, the price is lower because there's more outcomes. The same with volatility. If you jack up the implied volatility, there are more possible outcomes in the model happening. Therefore, the price actually goes against you. This is why you do not want stagnant market conditions with increasing implied volatility. Key thing to know, sometimes the market goes stagnant because people are expecting maybe a big news announcement or a big report to come out or something to really move the market. Well, if these binary options are going to expire after that announcement, then the market maker is naturally going to say, hey, you know, there's more likelihood that something could happen. I'm going to increase the implied volatility of my model. Therefore, even if price is stagnant and not moving around and the implied volatility goes up in that option market maker's model, the price of that option starts dropping. So if you bought it here, oh man, the price has gone stagnant. I'm now going in and it's trading right around this $80. Then they increase the implied volatility. Underline's not moving, but you're seeing it go to maybe $65 or something. Now you understand what happened. The implied volatility changes. And if the implied volatility goes up, it makes the extrinsic value more negative, which takes away from that intrinsic value with timed expiration. Now, that vega also changes as every minute passes in time. So you can see that as time passes and gets closer to expiration, the effects of the volatility shift more towards at the money. They go towards more to at the money. So, like if you're trading really deep in the money, the volatility changes as time gets closer to expiration actually don't matter that much. So let's say we were trading around this 2015. You can see that with 60 minutes to go, you know, changes in the volatility can affect your position. See, it's now -1, so every 1% increase actually hurts your position. Still, with 30 minutes to go, it hurts your position. 15 minutes to go, well, it doesn't hurt it as much, it still hurts your position. Look at what, you go down to 5 minutes to go. Yeah, implied volatility could be moving up pretty rapidly. It's not really hurting your position that much. Why? Because it's so far in the money. Let's take that same argument down here though. If it's only $2 in the money, you're trading 2012, and we're at a 2010 strike option, this hurts it, you know, as time gets closer and closer to expiration, it actually gets more of an effect on your position. Why? Because you're so close to the at-the-money prices. If this actually gets more volatility in the underlying, there's more likelihood it could drop out of the money. Therefore, the price is going to move closer to that $50 mark. Somebody else asked the question, implied volatility, is this function actually put into price by a human deciding to do so, or is an algorithm both, or a computer? It is both. Okay, it will be judged, you know, it depends on the market makers and how they have it set up, but they also have, like, they have ways that they can say, okay, I'm expecting something to happen, so I want a baseline implied volatility to do this, and then it can also, a computer can look at the volatility of the underlying and then affect the model from there, because you're going to take two accounts. Implied volatility is future expectations of what the market could do. It will also take into account what the market is doing. So if I had my binary option model up as a market maker, I could say, okay, I want a baseline. Let's say I'm expecting the market to get more volatile, and right now I'm pricing it at 30%. And I could say, well, I want my floor to now move up to 40% with over the next 20 minutes, and then every actual increase in underlying volatility can move the model even more. So it can be both. All right. You trade, I got another question. I trade ES, so the S&P E-mini futures, which binary correlates? That would be the US 500. Okay. The US 500 is the binary that goes off, that's the indicative index that goes off the E-mini S&P 500. Let me just go through a couple questions. So does it reflect the emotion of the traders in and out of the market? Well, we go through it this way. There's only really one input that an option market maker can affect their model. The only thing they can't affect time. Time changes on its own, right? And every minute that passes is automatically going to affect the price of the option. They can't directly affect the price of the underlying. That trades on its own. The only thing they can do is affect the price of the implied volatility. And they will do that based off of expectations of the market. Now you can say, does it reflect the emotion of the traders? I wouldn't say necessarily the emotion of the traders. I would say that they can take into account the expectations of future market actions, or how the market could be trading based off their expectations, because that's really the only input that they can affect the price of the underlying. So if they expect the market to behave in a certain way, they're going to change their implied volatility expectations. I hope that makes a little more sense. And they can affect their market at the model price. That's the only way they can directly affect the model price, because everything else is determined by the market or by time. Hey, Tristan, just keep working through this. You might have to listen to this kind of webinar a couple times. This is not necessarily easy to grasp when you've first seen it, especially these graphs. So, you know, if you're not, I don't really understand how this curve's shifting over time and why it's shifting closer to at the money, then, you know, the first step is to maybe go back to this graph, and this is at a specific time, or even this graph, and say, okay, you know, I'm trading theoretically at 2012, and now what would happen if the implied volatility went up? Look, it would hurt if we're still remaining at 2012 and implied volatility goes up, theoretically it hurts my position more. Then you can understand, hey, if I'm 2012, I'm here on this graph. So I'm only a certain distance from the at the money. But if I was trading at 2016, it would not have as much effect. You sort of have to build these concepts over time and watch this a few times and layer on these concepts. And we'll redo these webinars again live in the future. So you might watch this a few times and come back and re-attend this one and say, okay, I got what you were saying about this, but now here's my next question. That's the best way to get these concepts over time. And start watching also We've gone through the out of the money and in the money one. Go and watch how price starts behaving when you're trading these, either in your practice account, hopefully in your practice account when you're just learning this stuff, and say, okay, I know that when it's really close at the money, it's going to have more of these effects, and when it's really deep in the money, you can actually see the price changes.
Hey, Mike, I just want to throw something in if I could before you go on to the next slide. This is part of like those are great questions, and they're very normal questions. They're not unusual for us to see these kind of questions where somebody asks if the pricing has to do with the emotions of the market makers or the emotions of the traders. One thing I think that's lost on binary options traders when they first come in is that binary options are actually options, and the vast majority of what goes on with the pricing of these options is mathematically model driven. Okay, it's not that some big group of market makers thinks that the Fed's going to do something and they place an opinion in their price. The opinion manifests itself in the volatility and manifests itself in wider spreads, but not necessarily. These are mathematical models, and the reason that Mike can do these graphs for you guys is he's reverse engineered some of these models and built where the pricing would be. So this particular chart that's on your screen right now is a pretty spot on example of where price would be for this particular 2010 strike binary option given certain volatilities with certain expirations left. And the reason he can do that is because it is mathematically driven. And a lot of the times it is absolutely true that binary options are yes, no propositions, and they're 0 or 100. And the simplicity of that is something that we're massive fans of, especially considering that Nadex is regulated. You're not talking to some, shady binary broker who might run off with your money. This is a regulated exchange, and that's the only reason Mike and I would be associated with it. But when you talk about putting emotion in, that's a great question. This is the first time that type of question has come up in any of the webinars we've done. They're options. They're actual legitimate options that you guys are trading when you're trading binaries. They're not some made-up product that somebody puts their emotion into. They're mathematically driven, and that's why Mike can recreate these.
Yeah, I used to be an options market maker, and there's models for everything. I built all the models for the spread, the binary, or the Nadex spreads, the Nadex binaries, even just underlying options, and all these components are there's different nuances to each model, but they have in the effect, there's what Bob went through earlier in the extrinsic components, which were time, implied volatility, the interest rate, which would also, because you're trading these such short term, really doesn't affect it that much. So those are inputs into the model. Also the underlying and the strike price. You put all these inputs in the model, it spits out a theoretical price. Now, around that theoretical price, there's a bid and an offer. And they can widen the bid and offer, but they don't. If I was an option market maker in the binaries, I wouldn't just wake up and go, you know what, I think this thing should be priced at $62 because I feel it should be priced at $62. My computer is going to spit out with 38 minutes left and the implied volatility, maybe I put in a model or it came up with, however the model came up with it, whether it took the underlying volatility and then puts in some future expectations as modeled by the market maker. Let's say the computer puts in 38% implied volatility with 32 minutes left expiration. It's going to spit out a theoretical price for wherever the underlying is trading. So in this one, let's go back. So in this one, let's say let's just take something with here. My model says 30% implied volatility. We have 15 minutes to go. And the underlying is trading at 2012. It would spit out a theoretical price. All right, 30%, 2012, 15 minutes to go. We're trading at $70. Therefore, I'm going the bid ask, which is also updated automatically by a computer. Somebody doesn't automatically update that, is going to maybe be bid at $67.73. Depending on the assumptions for the bid offer spread. How do they come up with $67.73? Well, the theoretical value is 70, so the bid's slightly less, the offer's slightly more. It's not just, well, I think it should be trading 70. No, based off the implied volatility, timed expiration, where the underlying's trading, it's going to come up with a theoretical value. Now, if that implied volatility, for whatever reason, whether it's actually underlying volatility or whether it is, hey, the expectations changed in the market and now the market makers think the implied volatility should be higher. If it goes to 40% in the model, everything else remains the same, now that option's only 65. If they go, hey, it's now 10% implied volatility, we're still at 2012. Now that option model is theoretically worth that 90, so the bid offer would be on either side of that. That's how the theoretical models work, and those how the inputs all play into them. And then there's nuances to each market maker and how far their bid offer is from that theoretical model, and how they exactly model the implied volatility. So those are the things that they have control over.
So that's why we do these webinars, guys. We want you guys to understand that we can predict how the price is going to move. Now, there's inputs, obviously, as Mike just mentioned. There's other inputs. But you can actually look at particular times and particular markets, and if you have a process or a method that helps you analyze market conditions, and then you take what we're teaching you in these free webinars, and then you can actually have a good idea of what price is going to do given the unfolding of the market conditions that you're predicting. That's what it's not a guessing game at that point.
Yeah, with all this, what we're trying to do, I mean, I don't think many of you guys have ever seen, first of all, a graph of what the Vega does, over time. How does the Vega shift as time approaches expiration based off where the underlying is trading in relation to the binary option? No, it's not an easy concept to just magically grasp. But as you get this concept down, you realize, hey, as time approaches expiration and I'm in the money, any volatility changes where the implied volatility is increasing hurts me, especially if it's close to the at-the-money price. If I'm deep in the money, it doesn't really hurt me with a little time to go. Now, with a lot of time to go, implied volatility going up hurts me, even if I'm farther in the money. Those are the kind of concepts that, they take some time. So you're not, after you've watched a lot of these binary price changes, and then you go, I was seeing stuff and it didn't make sense with what I was seeing before. These are the kind of things that can help you understand what's really going on as time shifts, as implied volatility shifts, and as the underlying shifts. That's why we say, in this, I'm showing you the graphs. Why do we want stagnant or slowly trending price? Because I want it to remain in this box. Why do I want stable or falling implied volatility? Because rising implied volatility generally hurts me. Versus last week when we went over, hey, I want rising implied volatility. Why do I want rising implied volatility if it's out of the money? Because, look, out of the money, rising volatility, if price is staying the same but implied volatility is rising, it's actually helping me even if the price isn't moving yet. Now, eventually, if the price doesn't move, this option will expire worthless. But let's say we're at 2008 and it's trading 2008 on 2010. I put this option on when it's 10% implied volatility, and all of a sudden implied volatility shoots to 40%, and the price didn't move yet. That option went up in value and the price didn't move. Now, I don't want to hold it to expiration with it remaining out of the money. I want it to go into the money. But you can see how these things affect the option price, and these are a lot of things that people don't tell you, and that's what we are doing. Let's take a look at the delta. This is one of the final components, and I'll turn it back over to Bob. So it's important that the trader understands the delta of trading in the money binary option. The delta is the amount the binary option price will move in relation to a 1-point move of the underlying. So if the delta is 0.2, then the binary option price will increase or decrease 1/5 or 20% as much as the price of the underlying. If it's 0.5, it's 50%. If it's 0.8, it's 80%. Delta of a binary option varies greatly depending on the time until expiration and the distance the underlying is from the strike price. The farther in the money from the strike price, the lower the delta. When the binary option gets closer to the strike price, the delta increases. This is especially true when the binary option is close to at the money and as the expiration time approaches. Let me show you this graphically. Again, we're in the money, 2010 strike. This is a specific implied volatility. The only thing that I'm changing right now is the time to expiration. So with 60 minutes to go with the specific implied volatility, you can see, now these don't have the decimal places, but if it's 50, it would be half as much. So think of these as a percentage. If it's 10, it's 10%. So if you're right at the money, every 1 point move in the underlying, your binary option with 60 minutes to go will only move 10%. So the underlying moves 1 point, it would move 0.1. With 30 minutes to go, I mean, it's actually less than 0.1. It's about 0.08. With 30 minutes to go, it's about that 0.1. With 15 minutes to go, it's about 0.15 or 15%. With 5 minutes to go, it's about 25%. With 1 minute to go, and these are why you have, when it's at the money, you have these huge price changes when the underlying moves really close to expiration because your delta spikes real at the money. Let's look at it in the money. So if we're looking at just in the money, 2011, your delta, as you with 60 minutes to go is less than that 10%, 30 minutes to go to 10%, going up to that 20% and really spiking. So people don't understand, well, the underlying moved a lot, but my binary option didn't move that much, especially with a lot of time to go. Why? Because you don't have a lot of delta. Remember, what really produces the most of this option price changes, it's time decay, especially close to expiration. Now, you get way in the money where you don't have a lot of that extrinsic value. You've gathered enough delta, or the binary option has moved enough over time that you've generated enough that it has very little extrinsic value. So if you're way up here to 2016, 17, it doesn't have much extrinsic value, so you don't have a lot of time decay. But if you're down here close to in the money, the price movement of the underlying helps, the option increase a lot, some, as it moves further in the money, your binary option is going to increase in value, but it's not going to increase a lot, especially until it gets closer and closer to expiration. When things get closer and closer to expiration, especially close at the money, that's where you really get all this major binary option price movement, which can help you, if you're trading right around maybe just 2010 and a half, and it starts moving closer in the money with very little time left, that binary option price is going to trade. It's going to move pretty rapidly. However, if you have 60 minutes to go, it's not going to move that much, even if it's close to at the money. You're going to get the most bang for your buck close to at the money, close to expiration of these in the money. But remember, this is a double-edged sword, because if it moves out of the money, that's how these things lose rapid value. That's why I said you want a clear, maybe a support level here. So I'm long. I do not want it dropping below my support level, especially close to expiration, because that price change is going to be rapid. And if it goes out of the money, my position that I was working to capture that theta on now it's going to all go away. Again, Pat, is it best to buy a daily option 1 hour before expiration? You can't make a statement. There's not a blanket statement like that, because it all depends on market conditions. It all depends on the implied volatility. It depends on how far the underlying is in the money or out of the money. That's what we're trying to show you here. All these are moving conditions. So everything we're teaching now, you'll want to combine this knowledge with knowledge of a strategy, and say, okay, the strategy works best in these kind of conditions. And now I know this is how my binary option is going to react, so I can pair up that knowledge together. We've looked at some optimal conditions. Let's just flip this around to non-optimal conditions. So what are some non-optimal conditions? We don't want to be trading these in-the-money binary options during very volatile market conditions, especially with increasing implied volatility. That's not what's really suitable. You want the implied volatility to be falling. And you want generally, if these are going to be trending markets, you want them slowly trending in your favor. If something's quickly trending, that's when last week I'd say, hey, I'm going to probably go to an out of the money that's going to go in the money, and then I'll get the theta capture. I'm not going to be targeting an in the money position, especially if we could go into very volatile markets, especially if implied volatility could be increasing. We're also not looking to enter these in the money options when the underlying is trending against our position. We need it to stay in the money to get the benefit of that theta capture. We do not want this thing to be falling out of the money at all. Significantly increasing implied volatility combined with an in-the-money binary option moving towards the at-the-money price can be a very bad combination of factors. Why? Because remember, implied volatility is it's adding more negative extrinsic value, which is lowering that binary option price. Again, I'm talking from the long side. So my price is going down because the implied volatility is going up, and I'm getting closer to that at the money price, which is also that delta that I just went over is starting to deteriorate the option price. So that's a double whammy. So yes, I might be capturing some theta, but now I'm fighting that implied volatility and I'm fighting the trend. You can see that because, hey, I don't want this thing to go out of the money. Now, if it does start dropping out of the money, that's when I want to say, hey, I'm getting out of this position. I don't want it risking expiring out of the money because then it will be worth zero. So it crosses this boundary. I now know time's not working for me. Implied volatility wasn't working for me, and the trend wasn't working for me. The reasons I got in this trade are null and void. I'm just getting out of it way before expiration. Some examples when we would not consider putting on in-the-money binary option trades. So establishing an in-the-money binary option theta capture, crude oil, crude oil Nadex binary that expires at 11 a.m. at 10:20 before the release of the crude oil inventories. Why don't I want it? Because look, it's going to expire at 11 a.m. Crude oil inventories is going to be released before that. So this is not going to be helping me because implied volatility could be going up, which hurts. And actual market volatility could be going up that could hurt me. Those are bad conditions. Putting on an in-the-money US 500s, that should say binary, that expires at 4:15 at 8 a.m. when the non-farm payrolls is due to be released at 8:30. Why? Because I'm putting on a whole daily in-the-money spread that has a bunch of timed expiration. We're going into non-farm payrolls, so implied volatility can get going up, which also lead to actual market volatility. Bob, could you also, for that crude oil Nadex binary one too? So that would not be suitable. I'm better to gauge. I don't want something that's in the money that could fall out of the money. I'm not going to get the theta capture. Why am I not going to get the theta capture of this other one? Because I have, it's at 8 a.m. My theta capture is not going to kick in until, closer to when this thing's expiring. So why am I going to put on a position that could, move out of the money way before, that I'm not going to get the benefit of theta capture until way closer to expiration, and that I might be fighting implied volatility increases because I got a key report coming out? Those are all things that could go against me. Those are not suitable market conditions for me to put on this in the money. I'm better to go to one of those out of the money positions where a rising implied volatility could be helping me, where if this market starts trending in my favor, it could be helping me. And then this is the kind of thing where, hey, now maybe we've had a significant trend all day because it trended all off that non-farm payrolls. Now we're going into end of the day where we're above a specific support level that's holding. We have now that time decay really kicking in. That's when I want to consider putting on an in the money binary option, because now that time decay can be working for me, especially let's say implied volatility was still higher and started to fall. We're in that support level. We're maybe going to a range bound market into the close, or at least maybe a slowly trending market, long trending market into the close. Now that would be a more suitable place for me to put this on. Now, Bob, I guess you get to do the optimal. You get to be Mr. Positive again.
I'm Mr. Positive. We're going to be finished here with Mr. Negative. But, back to the question Mike addressed earlier where, I'm sorry, I don't remember the person's name, but said, should I put on a daily with 1 hour left? That, again, is taking a complex set of circumstances and trying to reduce it to one simple thing where you say, I can do this all the time and have probabilities in my favor. Mike just went through a situation where you could put on a daily with 1 hour left, but in the volatility circumstances he described, it wouldn't work for you. Conversely, we have optimal conditions when a trader might consider an in-the-money binary options trade. So don't look at it like a daily binary with one option left. Look at the optimal conditions. So for example, the underlying has moved the expected true range distance and is consolidating just above a major significant level. Notice that has virtually nothing to do with the duration of the binary at its origin or the amount of time left for that particular binary, right? It's that the underlying has moved the expected true range distance and it's consolidating just above a major significant level. And implied volatility is still relatively high and beginning to fall. Those are the kind of things you're looking for as opposed to a daily binary with 1 hour left, right? You want market conditions, not necessarily pure time conditions, okay? So implied volatility is still relatively high and beginning to fall, and there's still nearly 2 hours left in the trading day. Let's review a path trading setup that would be suitable for trading an in-the-money binary option. When we talk about path trading setups, these are strategies we teach. What we do at Path is we teach analysis of markets. And then in these free webinars we do for Nadex, which we give to everybody, we teach you how to apply that analysis to Nadex products. So let's take a look at it. So here we'd be trading a long in-the-money binary. You can see up at the top there, what we've got is the US 500. We've got a 1995 strike, a 1992 strike, and an 1989 strike. And what we have is a path trading double bottom pattern. This is a pattern that we teach. It's on our website right now. We have falling implied volatility with price reversing late in the trading day, which is one of the optimal conditions. And we have a single in-the-money binary strike with a strike price of 1992 was entered at a price of 70. So we've got our particular trade here, right? We've got the 1992 strike. We've got a 70 entry here, all right? Here's the path trading trigger. It's above a key moving average for us. Got everything in place that we want to do with this. Now, the trade went quickly to target. For anybody who knows what a double is, and we teach an advanced form of doubles, but anyone who knows what a double is, it's a reversal pattern. So a double bottom would predict a market going higher. A double top, which we had a version of right up here, would predict a market going lower. So the trade quickly went to target. And even though there was 35 minutes remaining, which again goes to the question that was asked, even though there was 35 minutes remaining, until expiration, we removed the trade at 95 since our target price was reached. Okay? So there you have it. Went all the way up to our target pretty quickly. We bought in at 70 and we sold at 95. Very simple. Why didn't we wait for that extra $5? Because once our price on the actual underlying is reached, okay, we are now risking the difference between 70 and 95, so $25, to make 5. That's a 1 to 5 reward to risk. We would never do that. Now that only applies because our target was reached. Okay? Our target was reached quickly, we removed the trade. That's an optimal example of a time we would put on an in-the-money binary. Now, if you look at the way that ticket would have appeared, right? When you bought that particular, let me go back 2 slides. When you bought this particular trade here, okay, this would give you a $70 risk and a $30 reward, right? But one of the beauties of Nadex binaries over many of the other binaries out there, not only the CFTC regulation, which again I mentioned early on in the webinar, is a big frickin' deal, that they're regulated by the same people who regulate the NYMEX, the CME, and every other reputable exchange out there, is that you don't have to hold the product to the entire $70 loss. You can exit it early. And had we reached a stop that we would have in this particular pattern, we would have. But instead, we're able to put that trade on and exit at 95. And that's the kind of thing that we look to do. We look to trade these like real products. Even though it's a yes or no proposition, right, a 0 or 100 proposition, it doesn't really apply because you're able to exit it. So you can actually get out of something early. In this webinar, we covered various aspects of trading in the money Nadex binary options, and we examined how some of the Greeks affect binary options. We also looked at the optimal and non-optimal market conditions which can help a trader determine when to trade in the money binary options. You will probably need to review this information multiple times and then determine how this information can work to further help you successfully trade in the money binary options with your trading strategies. All of you should have a trading strategy. It shouldn't just be that you go, I think it's going higher, and you put on a long binary, or I think it's going lower and you sell a binary. You should all have a strategy, and that's why that question was answered the way that it was. Is it okay to put on a daily with 1 hour left? Sometimes yes, sometimes no. Remember, you're trading options. These are real products. So you need to understand all the dynamics of them, and it's not just about, I have an hour left, I'm going to do it now. It's not just about the reward to risk on the bottom of your ticket, although that is important. Right? It's important for your protection to know that in a worst case scenario, if you're not able to exit, in our example, that loss would have simply been a $70 loss, right? Per contract, obviously. Those are important things, but they're not the only thing. It's not the only structure that you need to understand. And I think that's sometimes lost upon people when they get into a product that's as easy to understand as binaries are. So, Path Trading Partners, if you could, I would like it if you would follow us on Twitter. That would be nice of you. Like us on Facebook. And visit us at pathtradingpartners.com. Please visit our website to sign up for our free webinars. And by the way, we're considering building a tool that could graph the value in the Greeks. So if you guys would be interested in something like that, that's something we're considering building so that you guys can actually see the Greeks, the values of the Greeks being modeled out. Okay, so if we could, maybe you guys can just sign up on our website and let us know. That's something we're considering building and offering out to you guys. So please listen to our podcast as well, which is a favorite of mine, The Money Path, which can be found on our website, and read our blogs, which can be found on binaryoptions.nadex and also on our website. We are happy to sit around and answer questions. We're also happy to let you guys go, whichever you guys need us to do. So we're here to take any questions at this point. We always have webinars for Nadex, at least for the time being, on Tuesdays at the same time. So we would love to have the rest of you guys here again. Okay, give me the Kool-Aid. How does one learn how to trade high probability trades with PTP? Chris, you've been around for a lot of our webinars. I like that. So Chris is finally drinking the Kool-Aid. And I'm going to throw a little shot of vodka in there for you, Chris. Just go to our website. Go to Path Trading Partners and join. And there is a page where you can sign up in the pay for products. Okay, you just scroll down on the home page and you'll find it. Okay, so it's all there for you on pathtradingpartners.com. All right. Guys, thank you for all the compliments, but I'm just not going to read how great we are. I just don't want to read that. Mike, you better jump in because I'm just going to do that stuff now. I want to thank Jamie and Nadex and Jamie. Anyway.
I think you're getting all the questions.
Is this Jamie?
Negative. Okay, thank you. Thank you. I think that's about a wrap. No more questions.
Thanks, guys. Thanks to Nadex, and we'll talk to you guys next week.